Caesars reported earnings after the market closed on Tuesday, and this gave us a pretty good idea of what's going on in Las Vegas and also in regional markets, where there's points of strength, where there's points of weakness. If you are following the casino industry, you know that the last couple of years have just been absolutely phenomenal, particularly on the Las Vegas Strip. Of course, there was the pandemic, absolutely devastating time for the Las Vegas Strip. But coming out of the pandemic, the amount of gaming that was happening in Las Vegas far exceeded what we have ever seen on the Las Vegas Strip, and that continues. Now, things are pulling back just a little bit, but the decline is not all that significant, and it seems like we're going to be at these elevated levels for the foreseeable future. So I want to go through what the results look like, and then how this ties into some of the other earnings reports that we're seeing or that's coming out later. MGM reports after the market closes on Wednesday, but we do have some information about how BetMGM, their digital unit, is doing. So I'll highlight some of those digital trends as well. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right to the report. This is the overall look at second quarter earnings and losses for Caesars Entertainment. You can see that net revenue was $2.8 billion, down slightly from $2.9 billion a year ago. Also reported a net loss of $122 million. That was actually in large part related to a $940 million valuation allowance against tax and against deferred tax assets associated with their REITs. So again, one of these strange accounting things that goes on. Adjusted EBITDA fell. Same-store adjusted EBITDA was essentially flat at $1 billion, and Caesars Digital adjusted EBITDA was $40 million from $11 million a year ago. So digital doing relatively well. We'll get to some of these margin numbers because margins are a little bit under pressure. Here you can see the revenue segments and the adjusted numbers. And the adjusted numbers are going to pull out some of the divestitures. So the percentage change after those adjusted numbers, actually revenue was up a little bit in Las Vegas for Caesars. Regional casinos struggling a little bit more. This is something that we've seen kind of across the board, down 5.2%. Caesars Digital up 27.8%. And then these are kind of the other expenses. So overall, down just slightly on an adjusted basis to $2.83 billion. Adjusted EBITDA, and this is what I like to look at because this is a proxy for cash flow coming from casinos. It pulls out depreciation and amortization. Depreciation is going to be a really big expense for casinos because you're going to spend billions of dollars building a casino, and then you're going to depreciate it over 20, 30 years. But that's a non-cash cost. So this is going to give you an idea of how much cash is coming out of the business. $514 million, up just slightly from a year ago. Regional also down, some of those cost pressures, negative 7.7%. So overall, you have a slight decline on an adjusted basis in adjusted EBITDA, but about $1 billion. Keep that number in mind because on an annualized basis, that's about $4 billion in adjusted EBITDA. Debt has long been something that's been a challenge in Las Vegas. These were highly levered companies. That was how a lot of these casinos were built. That has really shifted over the last decade or so as there's been fewer casinos built, fewer acquisitions in the industry, and more cash flow coming from the industry. So cash and equivalents on hand, $830 million, not a ton of cash. There's about $12.3 billion worth of debt. So net debt, $11.6 billion for Caesars. Compare that to the about $4 billion worth of adjusted EBITDA. And that's not the lowest net debt to adjusted EBITDA ratio I've seen, but it's relatively reasonable as well. Now on the digital side, the business is actually doing pretty well. This is an update from BetMGM. So Entain owns half of BetMGM. MGM Resorts owns the other half. Their net revenue from operations was up just 6% to $1 billion in the first half of the year. Q2 net revenue was up 9%. So you're going to see a little bit more increase from Caesars digital properties, which they acquired during the pandemic. And on an EBITDA basis, the loss for the first quarter for BetMGM was $123 million. This is a look at their guidance, but the theme is really consistent across the industry in online gambling, iGaming, or sports betting, and that's that it's really hard to make money. It's really easy to grow your revenue because you can just acquire customers by advertising more, by giving more incentives, but it's very hard to turn that revenue growth into actual bottom line performance. So that's something we've seen across the industry. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So for Caesars, you definitely have some weakness in regional resorts. That's going to be about half of their revenue. MGM's not going to be in all that dissimilar of a position. The difference with MGM is that they have exposure to Macau that has long been the biggest cash flow machine in the gaming industry. So you have that positive to add to their business. For Caesars, the market cap of the company is now about $8 billion. So your enterprise is about $20 billion. If you just annualize their adjusted EBITDA numbers, their enterprise value to adjusted EBITDA, you get to about 5 times. So that's a relatively low valuation. This is something that we see really across the industry right now. MGM is choosing to buy back their stock with their cash flow, something that Caesars did not do this quarter. And in fact, their weighted average shares outstanding were up just slightly to 216 million in the quarter. So this is really going to be the question for all these companies is, can you turn that cash flow into value for investors by paying something like a dividend, by buying back shares? MGM has a clear path to doing that, and they have been doing that for quite a while now. Caesars, in a little bit of a different story, I would probably pay down their debt a little bit more because they do have a pretty significant debt load, don't have a ton of cash on the balance sheet. Again, they don't have that cash flow machine coming from Macau like MGM Resorts does. But hopefully this gives an idea of where we're at in the casino industry. As an investor, I'm definitely leaning towards a company like MGM. You have a little bit clearer path on what their path forward is. Caesars is going to be operating in a little bit of that lower end of the market and more of that regional market. So the margins aren't going to be quite as high there. They're also going to have to reinvest more in their casinos on an ongoing basis. They've got an absolute ton of casinos. I'm looking at their list of casinos that they have on their website, and there's about 25 different properties that they have to update on an annual basis, redo their rooms. So adjusted EBITDA is a great proxy for the cash flow that's coming for the business, but it doesn't include the cash that has to go in on that ongoing capital expenses. So that's going to be another one of the challenges that Caesars has versus some of their other casino competitors who have a little bit more cash flow on top of what needs to be reinvested in the business. But look for potentially this to be a cash flow business going forward, and the kind of company that can either pay dividends or buy back stock. That's where the value is ultimately going to be added from Caesars Resorts, and that's exactly what I'm looking for from MGM Resorts after the market closes on Wednesday. So check back if you want to hear my thoughts on those results. Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.